have a really simple problem set up here concerning adjusting entries. Before, I just want to say I set up the balance sheet and the income statement. Just to review, whenever an asset increases, it's always a debit, and whenever a liability or an owner's equity increases, it's always a credit. Alright, so let's look at this. Invested, the first transaction is that we invested $40,000 of our own money into Bite Size Corporation on May 1st. So into the company we put in cash for $40,000. And we credit common stock because original investments are most of the time credits to common stock for $40,000. I have 4,000. Let me just fix this. Okay. We're gonna post all our entries into the balance sheet or the income statement after we finish. The next is we paid $24,000 for 12 months of rent in advance. Since we paid in advance, it's not an expense, but it's an asset because assets are things that we're going to use in the future. So since we're paying in advance, it's an asset, and the asset is called prepaid expense. Prepaid rent for $24,000, which represents 12 months of rent. And how did we pay this? We paid it using cash. Now the next thing says on May 31st, we made an adjusting entry for rent. If you look back, we paid the $24,000 on May 1st. So on May 31st, we made an adjusting entry. What are we adjusting? We're adjusting this prepaid rent account because this $24,000 represents 12 months. So we have to reduce $24,000 by 1 month's rent. How much is that? It's $24,000 divided by 12 months, which gives us $2,000. So we're going to have a $2,000 debit to rent expense, and then we're going to credit prepaid rent. Since this is the adjusting entry and we're adjusting prepaid rent up here, we don't credit cash because we already credited cash when we paid $24,000. So we just adjust prepaid rent. Now we can put our 6 journal entries into the balance sheet and income statement. First, let's start with the simple cash. We have a debit of $40,000 and a credit for $24,000, which gives us a debit of $16,000. Our company has $16,000 of cash at the end of May. Then we can go ahead and put the common stock down here in owner's equity. $24,000 credit. Okay. Next, we have an asset, prepaid rent, $24,000. However, we subtracted $2,000 at the end of the month for 1 month's rent. So this becomes an asset and it goes here for a total of $2,000. Sorry, for a total of $22,000, which is $24,000 minus $2,000. Last, we have rent expense, which is an expense account, and it's the $2,000 is for the rent that we used for being in the building. Expense minus $2,000. Now remember I said in an income statement, the total of the income statement, which is only minus $2,000, comes over into this box called retained earnings. So I'm going to go do that right now. Now to check it, there's 2 ways to check it. One of the ways, like I said, is if the assets added up equal the liabilities and owner's equity down here. So do they? Let's see. Assets is $16,000 cash plus $22,000 for the 11 months rent remaining that we can use. Gives us $38,000 of things that the company can use in the future. Let's look at down here. Liabilities, we have none. owner's equity. Oh my, this should be $40,000. I don't know why it's $24,000. It should be $40,000 right here. Okay, so we have $40,000 minus $2,000, which gives us $38,000. So yes, assets does equal liabilities and owner's equity. So we did this correctly. Cool.